Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. I'm your host, Daryl Thomas, and today you are in for a treat. You are receiving exclusive content from the New Orleans Investment Conference. I had the opportunity of interviewing multiple experts within their respective field in the finance and resource sector. So be sure to hit the subscribe button. Take a look at this statistic. Over 91% of people that have watched my channel over its lifetime have not subscribed. So hitting the subscribe button only takes a second, and it is free to you. And for me, when I put out this content, it costs me money and time. So I hope that you all understand that and hope that you consider hitting the subscribe button. So without further ado, let's get to the interview. Hello, everyone. Welcome back to the Money Level Show, where we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. Today, I am here with Lyn Alden. Lyn Alden has been on my channel back in 2021 when I didn't even know what I was talking about, but glad to have you back. And I know that you've grown a whole lot since then as well. I mean, you just wrote an amazing book that has a lot of really good reviews, Broken Money. Be sure to go check that out. It's on Amazon and everything. And so, how you doing today?
I'm pretty good. Happy to be back on the show. It's been a while. Yes,
indeed. Yes, indeed. It's been a grind on my end too. And so, it's not for the faint of heart.
Yeah, no, it can be a very tiring business to. If you run your own business, you're always on. You never kind of clock out. There's always things you're thinking of. There's always more you can do, and it can be a challenge to have work-life balance.
Yes, agree. I'm married with 3 kids, so I'm trying to stay in it. I did take a 6-month break earlier, end of last year, and then I had to try to dive in. So I'm watching your interviews and Luke Groman and okay, where are we at? Because things just change so rapidly, and so you got to stay on top of it. Yeah. So we're in New Orleans. Do you eat much of the food here? It's a lot different than a lot of places.
I want to. I've barely gotten a chance yet. I flew in last night. It's been kind of a wild ride since then.
Yeah, I'm used to it. I'm from the South. Fried catfish is my thing. I don't eat it much because there's too much sodium. It's fried and stuff. I live in Washington where we eat crunchy carrots and stuff like that. So we eat vegetables and fruits. Here it's hard to find a vegetable that isn't a lot of spices and salts in them. So I'm enjoying myself, but eventually when I get back home, I got to get back on the straight and narrow. So take care of our health. I'm glad to have you here, and I wanted to just start. I was at George Gammon's workshop last night, and he showed us a chart, and he asked us if M2 money supply and the gold standard, if that prevents governments from spending. And so he showed us a chart now. Then he went back to the period from 1880 to 1905, and government spending was the same as today. And so then he shows us a chart, with obviously government spending increases during war times and such. And pretty much, is government spending, is that the main cause of inflation? So, or the devaluation of the dollar? Is it the Fed, or, it could be both, but does government spending play a huge role in that?
So I think it's both, and different eras have different priorities. So for example, in the 1940s and the 2020s, most of the money creation, the extra money creation, was from large monetized fiscal deficits. The 70s were different, which was that we still had deficits, but most of the money creation was from bank lending. The way I would describe it is that we have a fractional reserve system, which means that money is lent into existence. And so you have 2 tiers of money. There's base money and broad money. And broad money is just a fractional reserved IOU for base money. And the challenge is that during periods of credit expansion, more and more broad money, the ratio of broad money grows compared to base money. And eventually you run into a massive crisis when this happens. If you drive interest rates all the way to zero, you drive debt higher and higher. When we get to zero or even sometimes slightly below zero, there's nowhere to go. And so eventually that starts collapsing. And if you do not expand the base money, if no one can print the base money, then that broad money supply will start collapsing down towards the base money. We saw this in the Great Depression. About a third of the M2 broad money was destroyed. And that process was going to keep happening. But then the government and the Federal Reserve stepped in and said, you know what, we're going to increase the base money, and we're going to do bank holidays, and we're going to kind of make this money good. And they kind of stabilized it and started growing it from there. A similar thing happened in 2008, where you hit zero, you hit tons of debt, starts collapsing. This time they, of course, were way faster with the money printers. They come in, they just double the base money supply. They arrest the drop in the broad money supply. And so the way I would phrase it is that, the Fed is not necessarily directing that broad money supply growth during that expansionary era, but what they do is they step in and they help it stop from shrinking. And so it basically locks in those prior decades of money creation. They say, okay, that's actually now money good. All the exponential credit you've created, fractionally reserved, we're not going to let that collapse. And so it retroactively solidifies that inflation that already occurred. And you can't do that without a flexible monetary base. So it's not just fiscal, because if you had fiscal, but if you had just had an inflexible monetary base, it doesn't matter because it would still collapse towards it. The bonds would default even at the sovereign level. But the combination of the fiscal and the flexible monetary base is how they have this permanently expansive system.
So right now, we're heading towards 34 trillion in debt, budget deficit, 1.7, 1.8 trillion. It's probably going to go higher. I mean, like the trillions are just stacking on like Pringles, right? You know what I'm saying? And I'm just wondering, like, how does this, obviously Japan has increased a lot of debt, but I believe their consumers have, surpluses and less debt than the government. And so how does it look for us? I mean, we have, debt from consumers, we have debt from government and corporations. So how does this look for us?
So our corporate debt or household debt are not as high as some other countries. There's a number of countries in Europe that have much higher household debt because their real estate values are inflated. It's like funny, different countries in the world have different bubbles. So in countries that don't have very deep stock markets, usually their housing markets get bubbles. So Canada, Australia, parts of Europe. In the United States, we have a very robust equity market, private equity, all sorts of things like that. And so our real estate usually does not inflate as much as other places. Instead, it's in the capital markets. And that results in lower household debt. I think the biggest issue faced in the US is that in addition to our large debt, sovereign debt and fiscal deficits, we have the trade deficit. That's what makes it the opposite of Japan. So Japan, although they do have their sovereign debt problems, it's somewhat offset by the fact that they've historically run decades of trade surpluses. They build up a very positive net international investment position, tons of reserves. So they have a lot of ammo to slow down the decline of their currency, to pay some of their oil bills and things like that, if they should run into kind of shortages there. They've got this big stash of acorns they can start eating in the winter that we don't really have. A lot of our benefits are more in the present. So our powerful geography, our attractive capital markets, our network effects of the English language and economic size, whereas we don't really build up these sovereign reserves. And so the fact that we're now running very large fiscal debts and deficits, and we have a trade deficit, is where we start getting into, I think, a more structurally inflationary environment than we've been accustomed to in the past couple of decades. And I think that's kind of the main risk going forward.
Yeah. So, so what I hear you saying is that Japan has a lot of debt, but they have a lot of assets, and so they're running trade surpluses and they, obviously export a lot of goods and such. And so they're in a better position because of that. So looking further out, I had the pleasure of interviewing Neil Howe on my channel, and the fourth turning. I mean, it just seems like crisis after crisis. I've only been in this 3 years. I just told a guest the other day, like, is this normal for, investment markets or what? Like, I mean, I went through the pandemic, then, Russia, Ukraine and banking crisis, now Israel, Hamas, and, it just seems like things like the deck just keeps getting stacked, and this is all after the GFC, and such. And so, Neil is projecting that 2030, we'll have some sort of crisis that will have to revert things to mean. And then he also mentioned that natural resources, that we have to invest in infrastructure, we have to invest in resources and real stuff. And that seems to align a lot with your view and such. But do you see this getting worse before it getting better? Kind of what's your view on it? Hey everyone, sorry for the break in action, but I have to let you know that I am now an affiliate with Miles Franklin. Miles Franklin has been a bullion dealer for over 30 years, and they provide some of the highest quality service to their clients, as well as fair pricing on bullion products. So purchasing bullion through Miles Franklin not only stores wealth for yourself, but you're also supporting this channel to continue to provide free educational material for retail investors and those who may not be aware of many financial concepts that I discuss on this channel. So you can get started by sending an email to info@milesfranklin.com or calling 952-929-7006. Be sure to let them know that Daryl Thomas or the Money Level Show sent you, and I will receive credit for your service. I thank you all for considering this. Now let's get back to the interview.
I think I have a lot of overlap with his work. And what I find interesting is that my side is the more quantitative side and his is the more qualitative side, in the sense of he comes at it from his demographer background. So tracking generations, how one generation feeds the culture into the next generation, and but it changes. It's like a pushback against the prior generation. So that kind of four generation cycle is very fascinating. My work is more in the financial realm. So watching financial imbalances build up, watching geopolitical imbalances build up, and eventually institutions start having entropy. So you build an institution in one era, and then roughly 4 generations later, it's like that's a very antiquated institution now. It's been corrupted. It's been kind of captured. It's no longer serving the newer generations, and they don't really associate it with it anymore. Trust in those institutions fails. And so the way I would put it is that all of the 4 turnings were sovereign debt crises to one degree or another. And that's what we're going through now. So with the global financial crisis, you had the major private debt bubble. In order to get out of that, they printed money, and they also pushed a lot of debt onto the public ledger. And that's the second part of the crisis, is when that's all the way up at that level now. And that's when you risk a more inflationary rather than disinflationary crisis, and you risk more of the currency itself. And so I think that the overall timeline of crisis goes from global financial crisis all the way up into the 2030s is roughly in line with how long these things take to play out. And right now we have kind of record political polarization, very large wealth concentration, growing populist movements on both the right and the left, and then the establishment kind of out of touch and trying to keep the power they have. BRICS kind of coming back against the dollar, trying to align themselves to, we'll see how successful that is. We have Bitcoin and decentralized technologies. This is all kind of coming to a head. And I think by the time we get to the 2030s, we get a lot of these questions answered. What has happened by then? And so I think those timelines make sense. And I enjoy his work because it provides a more qualitative aspect that kind of helps me think through some of the quantitative things, which is more of my focus.
Mm-hmm. Got it. Yeah, that's pretty interesting, like just in terms of, obviously investing in natural resources. Like right now you have a lot of energy security issues. I mean, and with the polarization, and you got issues with OPEC and Russia and all these different things, that it's like now countries or nations are like, okay, we need to secure our own a supply of critical materials and such. And so is this like the end of globalization? Do you think that globalization is coming to a halt? Or you tend to have a pretty optimistic view. I think that you've helped me through a lot of situations because you get a lot of fear mongering. Oh, the BRICS is starting a gold currency. Oh, many different things, right? I can go down the list, but it takes time for this stuff to play out. But is this like globalization at a halt? Like, what needs to happen for this to even work again?
So during the 1800s, there was a rapid period of globalization. And we can define, there's a number of ways to measure it. We can define it as global trade as a percentage of global GDP. That's probably a good way to do it. So it was rising throughout the 1800s, early 1900s. It ran into a brick wall in World War One. And so from World War One until the end of World War Two, you had declining globalization. Then after that, you had a resumption of globalization, which really kind of kicked into overdrive in the 80s when you had the opening of China and then you had the fall of the Soviet Union. So the past 30 plus years, 3 to 4 decades, have been kind of the peak globalization. You know, you have one kind of hyperpower. You had Eastern labor coming together with Western capital. You had Russian resources connecting with, you know, European industrial base. All these things kind of came together and really kind of benefited each other. Now I think we're entering another one of those kind of intermissions where we recede in terms of global trade as a percentage of GDP, or at least at the very least we flatline. And maybe we don't just revert at all, but we don't keep going up. And so when you're going up, that means you're finding inefficiencies and you're kind of connecting them together. And we're either no longer doing that, or maybe we're pulling back and we're building redundancies, which is more resilient, but also more expensive, more inflationary, less hyper efficient. And so I do think we've kind of pushed that as far as we can. And now we have, you know, multiple poles of power that obviously can conflict with their worldviews and their cultures and things like that. When we talk about optimism, you know, I think that most problems are solvable. And so when people ask me what could go seriously wrong, it's generally 3 areas. One is energy security. You know, without energy, things get bad very quickly. Number 2 would be breakdown of societies. So when just the culture itself crumbles and the government collapses, and then like this other government comes in and it's even worse, and then you know, that kind of a breakdown of social norms, of things like that. And the third would be obviously like a major war, like an all-out total war between nuclear armed powers. To the extent that you can avoid or mitigate those 3 scenarios, things like currency crises, sovereign debt crises, these things are navigatable in ways that are unpleasant, but not necessarily doom scenarios. You know, sometimes I'll say, I expect inflation to happen, and we have kind of a fiscal spiral going on, and someone will say, "You're a doomer," and I'm like, "No, I just got back from Egypt, where they had 37% inflation, and people are going to restaurants, the streets are full, people are in the malls. You know, my friend's daughter there wants me to watch Disney movies with her. You know, this is it. Life goes on. It's just, of course, people are struggling more than average. But this is like a background thing that they deal with, right? Well, some of the things I describe as a crisis in the U.S. or the developed world are like the average Tuesday in many parts of the world. So I think we're going through turbulent times, and I am concerned about a number of things. And so my eye on the ball is basically, don't mess up energy security, don't have major war, and maintain some degree of civic virtue. If you do those 3 things, there's a lot of crises that can be unpleasant but solvable.
Yeah, definitely. Yeah, and I probably used the wrong word, optimism. Like it kind of makes it seem like it's one way or the other. You know, like you got the super pessimist, doom gloomer, you got the super optimist. I see you as more in the middle of like looking at the pros and cons of
cautious
both
but
sides.
constructive is how I try to look at it.
Exactly. So I want to chat some about Bitcoin, humanitarianism. That's something that's been at the forefront of my mind in terms of looking at Bitcoin and such, and you know, just the case for it being a way for people who are bankless to be able to access an investment tool, a sound money tool, especially people that are experiencing inflation, hyperinflation. I mean, there's a gentleman here with a company in Argentina, and he talks about how their employees are really hurting because of the inflation there. And so you've done a lot of work in the Bitcoin community. I mean, you've traveled abroad and seen many different things. And so and it seems like, you know, this has a greater purpose than just like the price going up, you know, and, you know, sound money, as well as access and equity for those who are in other nations that don't have what we have. And so, could you just share, more to that?
Sure. So I think the problem we're in like a local maximum in terms of technology. So the technology of money, which is that we have fast transactions but slow settlement, which means that these centralized powers basically control the ledgers. And so there's 160 plus currencies in the world, and if you're not in some of the best ones, you're basically in a currency bubble where your currency is likely increasing supply at a very quick rate, and your currency is not accepted almost at all outside of your country. And the only way to bring money in or out of the country is really two primary ways. One is physical ports of entry, cash and gold, but obviously that's very limited by design. And number two would be bank transfers, which are, again, very surveilled, government enforced. If you get an incoming wire, they can transfer that into your local currency. They can make it so that you can't get the dollars, or you can't get the euros, or you can't get. They can redenominate in whatever you get. I know in Egypt a videographer, and he does work denominated in dollars for foreign clients, but when it hits his bank account, it's Egyptian pounds, right? And that's just how it works for a lot of people in the world. And what Bitcoin and some degree stablecoins do is they pierce through these two things, and they say, well, if you're having a video call with someone and they hold up a QR code, you can send them money. As long as they have access to internet, emails, DMs, video calls, things like that, you can send peer-to-peer money that goes around their banking systems and around their ports of entry. In addition, someone can bring infinite value density through an airport. You can memorize 12 words and bring in $1 billion of Bitcoin through a port of entry. No one can prove you have it or don't have it. And so that kind of breaks these boundaries that we've built between ourselves, right? So a lot of these countries are corrupt, authoritarian. They're also pressured by external forces in many cases. So there's neo-colonialist, issues at play. And what this does is it says, okay, instead of being in your own currency monopoly, you can now potentially have access to foreign assets or sound money, right? So for example, someone in Egypt, they're in 20% currency supply growth every year. They're on a treadmill to get their wages and savings to keep up with that. The local stock market's not very robust, so most people buy real estate, which is illiquid. I know physicians that stack cash dollars that they buy in the gray market. It's almost like you're going to buy marijuana, but you're buying dollars. It's like a funny scenario. And of course, you're prone to theft, fires. You can't trust your bank to hold that for you, especially if you're not wealthy. And so stable coins are basically offshore bank accounts for the middle class. That's kind of that's the bridge they solve. They say, okay, well, they're centralized, but the central hub is in Switzerland or the United States or Italy or, Dubai, wherever the case may be that wants to provide that jurisdiction. And then, of course, Bitcoin is about as decentralized as you can get, where there's no central hub and people can access sound money and be able to trade with each other without going through these firewalls and these borders. I mean, Latin America, I believe, has 30 plus currencies. Africa has 40 plus currencies, and all of that represents frictions of trying to trade with each other. That's a massive barrier compared to, say, the United States, which has just relatively free trade, or Europe that has relatively free trade. These are frictions. And what some of these technologies can do is give people power over their own. They can save in a finite asset, or they can potentially buy foreign assets in certain ways. They can bring their money with them across borders or globally should they ever decide to leave their jurisdiction for another one. They can receive payments in a unit that they prefer rather than always having it translated into their own little currency bubble. And they don't have to just continually get diluted by their government or by major banking cabals. I think that's a very powerful humanitarian technology. And for example, the Human Rights Foundation focuses heavily on Bitcoin and stablecoins because they say, okay, well, there's about half the world living under shades of authoritarianism. That's what they do work. They try to support democracy advocates, or at least human rights advocates, people that want rule of law and freedom of speech around the world. And they recognize that I think a lot of other similar institutions don't, that financial freedom is a key part of that. It's hard to be free in speech if you don't have control, if your bank account can be frozen arbitrarily, or if your currency is diluting 50% a year. So they focus heavily on the financial angle, and I think that's important.
Yeah. That's amazing. Just for people to even be able to access that. I have some friends in other countries. One of my friends, he's in Kenya, and he's been having a really hard time out there, and so people definitely are feeling it, across the world. And so I wanted to transition a little bit to some assets. I mean, we're here at the New Orleans Investment Conference, and so there's a lot of gold bugs here. And I'm bullish gold long term, but I'm use it as more of insurance for my money rather than like an investment, unless I'm getting into like some mining or royalty and streaming companies. And so what's kind of your take on gold at this time?
I like gold. I'm bullish on gold. When you look at central banks around the world, they don't necessarily want to have all their reserves in the U.S. Also, when you think of a sovereign reserve, there's kind of two parts of it. One hand, no country ever wants to ever draw down its reserves to zero, right? That'd be obviously a very bad, something terrible has happened if that has happened. So there's basically like their savings account, which they don't need to be as super liquid, but they want it to be secure. And then there's the part that they want to be able to buy and sell very quickly, right? They might want to defend their currency. They might want to pay for oil, and So for a long time, a lot of countries would hold all of that in dollars, or a big chunk of that in dollars. And I think now a lot of them are saying, okay, we can hold some dollars for quick, transactions we want to do, but for the bulk of it, maybe we want to put that in gold, or maybe we want to diversify that into a couple of different currencies. Maybe we want to make deals with Brazil to basically have a iron exposure for the next 10 years. Maybe we want to do kind of these private equity things. These are these less liquid things. And so I think we're seeing more diversification, and gold plays an important role there. Gold has often played the role of a insurance against kind of financial catastrophe. Going forward, even if we enter a Bitcoin world and digital world, there's never a guarantee that you're always going to have access to the internet. Your private keys can be stored offline, but your ability to interact and receive, send payments and, kind of make verified transactions, I think that could be limited. And so I think gold still serves a role for what if the internet gets disrupted? What if there's a cyber attack? What if the power goes out? What if this happens? What if kind of true mayhem happens, right? So I think that gold still has a role as a reserve asset, both at the sovereign level and the household level. It just doesn't really solve things at the transactional level. So I'm bullish long term. I think that basically as the dollar over the long term enters more of a fiscal spiral type of scenario, where you have very large sovereign debts. If you have inflation and from those fiscal deficits, interest rates become a very mixed tool for fighting that, because interest rates blow out the deficit even more at these levels. It's not the Volcker era where you had 30% debt to GDP. And so the challenge is that I think a number of entities are going to seek alternative monies. And Bitcoin's still too small to really kind of serve at the sovereign reserve level, especially for large countries. Maybe it has to go through a couple more liquidity cycles, get tested a little bit more to see how it's doing. So, gold kind of still stands there as one of the strongest monetary networks in the world.
Yeah, that's really good take. So you mentioned in one of your recent newsletters, you have no strong conviction on the miners, and you're focused more on the royalty streaming. What benefits about the royalty streaming? I actually just interviewed Sandstorm Gold earlier today, and they're a royalty streaming company, and I was talking to them about the benefits of it. What are some of the benefits and hedges to risk do you see with the royalty and streamers?
So with miners, one of the biggest expenses is energy in its various forms, and so I'm bullish on gold, but I'm equally, or maybe perhaps more, but also bullish on energy, including oil, diesel, things like that, long term. And the problem there is that you can have a mine where your revenue is going up because the gold price is going up, but also your expenses are going up. All your diesel costs are going up. Even things like tires, they're made out of, all that equipment is going through tires on a regular basis. That's all made of hydrocarbons. And just all of that energy intensive work, the manufacturing of the machines, the diesel powered machines. And the problem is that if that's going up as quickly, your margins might still be squeezed. Gold royalty and streaming company gets almost all that upside, but doesn't really have to worry too much about that energy kind of cost, of course, but you're paying a higher valuation for that exposure. So I'd say that if someone is a lot more bullish on gold than oil, then the miners are probably quite interesting for them, because basically they're assuming that their analysis suggests that the revenue is probably going to go up more quickly than their costs. If someone is bullish on both gold and energy, they might then look into the streamers because they say, well, I want to arbitrage the fact that both are going up and I want my expenses to be fixed. In addition, just streamers tend to be more diversified, a little bit lower risk. As a investment analyst in the macro sense, I don't really have time to kind of look through the geology of different companies. I'm not Rick Rule. I'm not going to go out there and identify these like really kind of complex situations. And so for me, I either stick to broad diversification, larger companies, streamers, things like that, to the extent that I want exposure other than just the physical gold, whereas someone who's more hands-on, they want to take all the risk and reward, can go into the more exploration type of areas or small caps and things like that.
Yeah. So that was kind of what was coming in my head when I was talking with Sandstorm. It's like they do the homework for us, and so they go and assess jurisdictional risk, what projects are worth funding and things of that nature. So that's very helpful for a lot of people that don't have the time or the knowledge to go into the space and get into the weeds of everything. So crypto, we have Bitcoin and you have crypto, right? And so we're coming up on a halving cycle. There's been a lot more technology built. And so, but there's still this issue with liquidity still being flat. And I know that oftentimes many risk assets run with liquidity going up. And so what are you kind of thinking there?
I think so far, all of Bitcoin's major bull runs have occurred after halving and with positive liquidity conditions. We never really had one where just one was present. And that's often because liquidity cycles historically are about 3 years. And the halvings have been 4 years. And so generally you get an overlap there. And so that's why the halving doesn't really, Bitcoin's bull run can happen right after halving. It can take a while after halving because historically it's been both happen together is when Bitcoin has its big moment. We can kind of think of it as like two monies competing. So the smaller money Bitcoin gets harder every 4 years. Basically, the new supply goes down. The bigger money is always expanding, but at different rates. And for a very brief period of time, it can actually contract. And so when the bigger money is contracting, it's basically getting harder for at least briefly. And so, Bitcoin's going to have its most explosive moments when both it's hardening and the bigger money is softening. Liquidity is improving. That's going to give you the most Bitcoin price action. If they're opposing each other, which so far has not really happened yet, but if it should happen, you probably would expect a more intermediate outcome where Bitcoin's, the supply-demand situations improve, but the liquidity of the other one is still also tight. And of course, the worst scenario is when Bitcoin's, not anywhere near halving and liquidity is worsening from the bigger network. Basically, the more of a mismatch there is, the more demand wants to flow out of the, expanding money into the scarce money. And whenever that takes a step back, demand dries up and there's really no catalyst. So I think that ideally you want to see both occur together. And I think eventually we'll see both occur together. Liquidity could happen right after the halving. It could take another year after the halving. It could take 6 months. I don't have a crystal ball on timing, but I do think that both are very important metrics. I think if someone's too focused on one or the other, they can miss out. If they say, I don't want to buy Bitcoin until liquidity is better, well, you might miss out on some of the cheaper exposures. On the other hand, if you only look at the halving and think you have to have a bull market after the halving, but liquidity from the dollar system is terrible in that time, you might get disappointed that it doesn't work on the time or the magnitude that you expect. So I think that both are helpful. And I don't really recommend trading Bitcoin too much, but I think it's more along the line of risk management, right? So if liquidity is low, if the halving's coming up, that's, and the price is low, that's probably a good time to start accumulating a longer term position. And if euphoria is high, if the price is high, you just had a post-halving bull run, liquidity's like soaring and it's starting to roll over. It's not necessarily saying you might want to time the top, but you might want to just make sure how exposed are you to Bitcoin relative to your net worth. Would you feel comfortable with a 70% drop or more? And if not, maybe rebalance, right? Or maybe hedge, maybe whatever makes sense for your situation. So it's more about risk management and expectation setting than trying to trade it.
Yeah. And we had I forgot the number of cryptos we had out there. It was in the thousands, right? And we had a lot of Ponzi schemes. I mean, we just saw the whole Sam Bankman-Fried and his testimony and stuff. That was bad. But I mean, like, are more cryptos being created, or are they reducing, or some of them going out? I mean, I still see like the Shiba Inus and all the meme coins out there, you know.
Cryptos rarely ever die. They eventually reach this like low level of, you know, almost dead liquidity. They're still there, they're still functioning, and more are created every day. The way I would describe it as, no matter how many pesos Argentina prints, it doesn't really affect the dollar, right? It's, you know, all these kind of long tail of stuff. The only thing that affects the dollar is like the euro, the yen, the yuan. What are the big ones doing compared to each other? So you can look at Bitcoin, you can look at Ethereum, you can look at stable coins, whatever, you know, Ethereum's competitor of the day is. Sometimes you have uprises trying to kind of compete with Ethereum. Those are the ones I think to generally focus on. And for me, Bitcoin and stable coins are the most interesting aspect of the space. They're the ones that are actually money, and blockchain is really good at money. That's one of the main things it solves. It's still remains to be seen kind of what else can be solved by blockchain technology. Some of these things could be interesting little venture tech plays. But generally what you see is you see a big bubble in a given crypto, and then it just never really kind of reaches its highs again, especially denominated in Bitcoin. And so if you're playing with 20,000 other cryptos, you're pretty much playing with fire, because there's really only ever been like 3 of them that ever made like a higher high in Bitcoin denominated terms in the next cycle, right? So if you're gonna play that game, just know that the odds are not good.
Yeah, it's a speculation game, pretty much. Tech stocks. I mean, the Magnificent Seven seem to be slowing down. You know, and they've pretty much carried the S&P and such. And so, I mean, most tech stocks, I mean, when I'm looking at like, you know, or growth stocks, I mean, PayPal, Twilio, and a few others, like, they're down significantly, you know, versus like an NVIDIA and Microsoft and such. And so, you know, it seems like, you know, they need liquidity to really start to boost up a lot. And so, what's your take on the tech sector?
So I think we can put them in 2 camps. The ones that are killed are mostly the unprofitable ones. And the reason is that they have to constantly issue new equity in order to fund themselves. And if liquidity dries up, if the discount rate is much higher, you know, if you get paid 5.5% on T-bills rather than 0, maybe you're more valuation sensitive to these types of names. And if they were undercharging for their product to be unprofitable, maximum growth, always relying on issuing new equity, and that equity dries up, they have a problem, because now they're unprofitable. How do they finance themselves? Well, maybe they increase their prices, but then that slows down their growth. And then that makes equity investors realize, I don't want to invest there, right? So it's like a lot of that was malinvestment that kind of gets rationalized in that world where it's just not okay to be perpetually unprofitable and always issuing equity. Eventually your business has to identify its profitable point at some point. On the other hand, the profitable tech companies have been very resilient in this environment. Somewhat to my surprise, you'd think that with a 5.5%, you know, discount rate, that some of these would be a little bit lower valuation. What we are generally seeing is that the Apples, the Teslas of the world, they're slowing down while they have very high valuations, which of course puts them at risk. Other ones like Microsoft, Alphabet, you know, they're still growing at pretty good clips, and they're profitable. And they're either able to hold shares flat, they're able to reduce their share count by buybacks if they want. And so they don't have the same problem that the unprofitable tech companies do. I think the main challenge that these Magnificent Seven are going to run into is not so much a crash or a major problem. It's more just like you could stagnate and go to choppy, and you know, you could fall 20-30%, bounce 10-20%, fall 10%, and you could wake up 5 years later and realize the stock's gone nowhere. And maybe earnings kept going up, maybe revenue kept going up, but maybe the valuation fell from 40 earnings to 28 times earnings, right? And it just kind of, you normalize over time. And I think that's the key risk. You have to kind of look at forward return expectations. And I think for most of them, it's not super attractive.
Yeah. Okay. And so transition into like emerging markets. I mean, the Chinese stocks, I mean, they've been getting decimated. I mean, JD, it's $25 or something, you know, like it came a long way down. I don't know much about China's economy and the macro environment there to really have a strong conviction on like, hey, I'm gonna go all in on these stocks even because they're cheap. So what do you see there, and is there any opportunity there?
So they're currently running the opposite playbook of the United States. So the United States is maximum fiscal, maximum consumption, and kind of weak production. China is tight on the fiscal. They're not just giving people money. They're not running massive deficits. They're actually running pretty small deficits relative to their GDP. Their output is full on. Their exports are soaring. Their trade surplus is near its all-time highs. They've recently entered the car market. They've already passed Japan in terms of number of cars exported per quarter, which is just remarkable. But their consumption is flatlining. So they're going through a real estate bubble. They're going through just a normalization on their consumption side, partly intertwined with the fact that they're not doing fiscal. If the Chinese government came out and gave every Chinese person $3,000 equivalents to go spend, you probably would have a boom in the JDs of the world, for example, but that's not what's happening, unlike the United States. And so with China, their industrial side is doing great, their consumption side's not. Now, I eventually think we'll get another cycle of the consumption side, but that's the challenge there. It's really kind of dependent on what Xi Jinping wants to do. It's a very centralized economy. And so far, they're really emphasizing the output side, not the consumption side. And so all the consumption side is suffering. They've also just done some kind of like top-down actions against Alibaba and JD, like a number of these companies, basically say like any excess profits you get are going to be threatened and kind of taken and redistributed to varying degrees. And so that makes investors say, well, maybe I don't want to hold this stock for the long term. I don't know what the changing political winds are going to happen to their bottom line, because they have all the risks of weak consumption. But should they get another really good bullish cycle, will the Chinese government just give them an extra $10 billion tax, for example, and take that from them? And so capital doesn't really want to go there too much right now. I think the Brazils of the world, I think there are other emerging markets that are more interesting on a risk-adjusted basis. That's kind of my take on it.
Okay. And then just want to wrap up with energy. So I've been looking more into the offshore drilling lately, as well as the tanker market. Do you have any specific thoughts on those two sectors?
So the energy segment, the whole energy complex, is one of the most areas that I'm bullish on with like a 5+ year view. Like I can't begin to tell you what's going to happen in 6 months, because that depends on recession or no recession. That depends on what China's going to do. Are they going to stimulate? Are they not going to stimulate? Because all of that affects the demand side. What we do know is that the supply side is very limited. So in terms of a new amount of capex that can come online quickly. The drillers are interesting because even to make a new drill ship, it's going to take years, and the shipyards are it's that's kind of a locked in supply. And it's a very cheap area, compared to replacement cost. So I think that as long as someone is careful with their investment decisions, energy is one of those areas that I'm not even going to try to trade too much. I just want to own it and see what happens over the next 5+ years, and then reevaluate. I monitor the space, but it's just not something that I want to trade. But it's just, I think we're due for another big price cycle, capex cycle, and just overall, that's what we're short on now. There's other areas that we're abundant in, and energy is the one where the world's pretty tight on at the moment.
Yeah, I've been looking outside of the U.S. Rick's been encouraging us to buy like the bigs, the Exxons, the Chevrons and such. And I'm like, Rick, man, I can get Eco Patrol and Petrobras like way cheaper with a way higher dividend. And so I'm trying to balance that out. But in terms of emerging markets, you have some really solid companies that average American investors aren't necessarily investing in. And so I'm kind of learning these companies on the Toronto Stock Exchange or in other nations, that are attractive investments. And so it's a lot out there.
Yeah, of course. The challenge is the jurisdiction. So basically, I think that's manageable with position sizes. An example I ran into is that, Lukoil has historically been one of the best performing oil majors in the world. They didn't do destructive acquisitions when many other companies did over the cycles. They managed themselves very well. But if you're an American holding Lukoil, you got wrecked through no fault of Lukoil. right?
You're like looking at my soul right now. I experienced that.
Yeah, me too. I was bullish on the company, and you just get blindsided by things that are just not in that company's control, and the company's still operating. It's just that your foreign claims for it are kind of highly questionable, to say the least, and that can happen in multiple of these jurisdictions. So I think that's manageable through position size. By not having overly aggressive positions in some of these more troubling jurisdictions, because there's this chance that a Brazilian oil company goes to zero, virtually zero chance that ExxonMobil is going to go to zero. But in a positive scenario, your upside from the Brazilian one is probably going to be much larger, right? So you can balance that by, diversifying, having decent position sizes. For me, I'm just so bullish in the energy complex. Last thing I want to do is be overly concentrated and make bad decisions and miss the bigger move. So for me, I want to capture the bigger move and take pockets of risk where I can.
Yeah, that makes total sense. I mean, because obviously in the U.S. there's due process, and versus other nations, like the government just can come and just make whatever decision and affect the company. So that makes total sense. Well, Lyn, I appreciate you for coming on. I know you just got off the plane and you got to get some food and all of that. And so where can people find more about you? Also, you all be sure to Broken Money. It's 500 pages, y'all. I think it's 500 pages?
Yes.
All right, it's going to take me about 2 years to get through this.
But it's very accessible.
It's good.
Yeah.
It's good.
So check out Broken Money. Check out lynalden.com for research.
How many pages do you read? Like, how many books do you read? You read a lot, do a lot of research.
I read a decent number of books, but for the most part, I look at research more than books. I crunch numbers. I look at articles. I look at documents more than I look at full books, or I read parts of books. I definitely absorb a lot of information, but it's not always in book form. And that's why I didn't write a book just for the sake of writing a book, because I don't want to read someone else's book for the sake of being a book. If you can make it an article, make it an article. That's what I try to do. The reason I wrote the book and the reason it's kind of well received is because I only wrote the book after I realized this has to be a book. This is not going to be a series of articles. I can't put the same information in that. It has to be kind of read in a kind of linear way to actually have the reader kind of go away with it. So I've been humbled by the reception from it.
Yeah, I got Neil Howe's book, I got Nomi Prince's book, and I got Lyn Alden's book. It's probably going to take me about 2 years, y'all, to get through these books. But I'm just finishing up my master's degree, so I did a lot of reading for that. But I'm going to be done next month, so got to be happy for that. And so then hopefully we'll be able to spend more time in research. And so thank you for coming on, Lyn. Y'all be sure to go check out Broken Money, as well as lynalden.com. Very accessible research. I mean, you even have a lot of stuff for people that are just beginning, like what's a credit score? How do you build it? There's so many tools there for you all to succeed and thrive. And so thank you, Lyn, for coming on.
Thank you.